The Fed held rates steady while there was mixed messages from the labor sector and home prices continued to hit new highs. Here are the headlines. Fed funds rate likely at its peak? Was January's job report really a blockbuster? Surprise uptick in December job openings? Home prices moving on up. Fed funds rate likely at its peak. After a period of aggressive rate hikes that began in March of 22, the Fed once again left their benchmark federal funds rate unchanged at a rate of 5.25% to 5.5%. This decision was unanimous and marked the fourth straight meeting where the Fed paused additional hikes. The Fed funds rate is the interest rate for overnight borrowing for banks, and it is not the same as mortgage rates. The Fed's 11 hikes between March of 22 and July of 23 were made to slow down the economy and curb the runaway inflation seen over the last few years. The Fed said they believe they have reached their peak Fed funds rate for the cycle. However, members don't expect to begin cutting rates until they've gained greater confidence that inflation is moving sustainably towards 2%. Note that the Fed's favorite measure, core personal consumption expenditures, declined to 2.9% annually as the latest report in December. During his press conference, Fed Chair Jerome Powell acknowledged that inflation data has been favorable over the last 6 months. However, he does not think the Fed will be ready to start cutting rates at their next meeting on March 20th, explaining that members want to see more good data. Was January's job report really a blockbuster? The Bureau of Labor Statistics reported that 353,000 jobs were created in January, which is nearly double expectations, and revisions to November and December also added 126,000 jobs in those months combined. The unemployment rate held steady at 3.7%. So what does this really mean? While the headline job growth figure for January appears strong on the surface, future revisions lower are very likely. January is always a heavily adjusted month as new benchmarks, seasonal adjustments, and population controls play a big role in calculating the data. In addition, there are two reports within the jobs report, and there is a fundamental difference between them. The business survey is where the headline job number comes from and is based predominantly on modeling and estimations. The household survey, where the unemployment rate comes from, is considered more real-time because it's derived by calling households to see if they're employed. This survey on its own job creation component, and it's completely a different story this month, showing 31,000 job losses versus those gains. Average weekly hours worked also declined to the lowest level since 2010, excluding the pandemic. This is important because it is one of the ways businesses cut costs is to cut the number of hours worked. On average, the entire labor force is working 30 minutes fewer per week, which equates to 2.4 million job losses on its own. Surprising uptick in December's job openings. The latest job openings and labor turnover survey, JOLTS, showed that job openings were stronger than expected in December, rising from 8.925 million in November to 9.026 million. The hiring rate rose from 3.5% to 3.6%, while the quit rate remained at 2.2%, suggesting there's a lack of employers trying to entice workers with other offers. While the Fed watches this report to monitor slack in the labor market, there are flaws in the data. The increase in working from home means job listings are being posted in multiple states more frequently. As a result, they're being overcounted in the JOLTS total, so the report may be weaker than the headlines suggest, especially given the number of high-profile companies that have announced layoffs recently. Home prices moving on up. The Case-Shiller Home Price Index, which is considered the gold standard of appreciation, showed home prices nationwide rose 0.2% from October to November after seasonal adjustments. This marked the 10th straight month of gains and a new record high. Home values in November were also up 0.5% higher than a year earlier, with S&P's DJI's head of commodities Brian D. Luke noting that November's year-over-year gains saw the largest growth in U.S. home prices in 2023. The Federal Housing Finance Agency's FHFA House Price Index also saw home prices rise 0.3% from October to November and 6.6% year-over-year, with their index setting new record highs in home prices every month since February. Note that FHFA's report measures home price appreciation on single-family residents with conforming loan limits, which means it's most likely to represent lower-priced homes. FHFA also does not include cash buyers or jumbo loans, and these factors account for some of the differences in the two reports. So what's the bottom line? Home prices are on pace to rise 6 to 7% in 23 based upon the reported pace of appreciation through November. These indexes show that home ownership continues to provide opportunities for building wealth through real estate. This has been the Drennen Report. I'm John Drennen, Sales Manager at Fairway Independent Mortgage Corporation. For the last 25 plus years, I have helped realtors nationwide grow their businesses through education, communication, and marketing platforms. Does your current lender offer you these same resources and tools? If not, contact me today and let's get you on a path of success. Now you're in the know.